Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
This week, it was a meta meltdown on Wall Street for Facebook. Mark Zuckerberg loses $30 billion just this week alone. But the good news, Southwest Airlines will now resume alcohol sales on longer flights. We'll have that and more tonight on Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up. I'm Andre Laborde. For today, for Friday, February the 4th, 2022. I hope your week went well. Well, the job numbers for January came out today from the Bureau of Labor. And while the unemployment numbers went up for the month, the economy added 467,000 more jobs last month. Also, the Labor Department separately revised payrolls from the previous December up, which was good news as well. Now, where are the jobs according to the Bureau of Labor? Well, leisure and hospitality picked up the most for an additional 151,000 jobs, as well as all the major sectors, including retail, transportation, and warehousing, as well as education and health services, all ended up. And speaking of jobs, what are the best jobs in America? Well, according to a recent survey from Glassdoor, the top 5 highest paying and most demand are enterprise architect, full-stack engineer, data scientists, developing engineers, and strategy managers. Now, you might be asking, what is an enterprise architect? Well, that's a senior IT manager who designs business tech infrastructure. Now, they're also a general contractor for IT. And the top 50 job openings with the most needed employees goes to software engineer. They need 64,000. They have 64,000 openings with a median base salary of $116,000 per year. Well, coming up, we'll be talking to the Chief Financial Officer of T. Rowe Price, David Giroux. Now, David is in charge of over $1.6 trillion in assets, where some of us may buy 100 or 200 blocks of shares. He oversees purchases of billions of dollars all at one time. And David's also got a new book out. He's written a new book called Capital Allocation, in which all the profits he's giving to charity. Now, David will be here in just a minute, but how did the markets do this week? Well, the S&P 500 as well as the NASDAQ had their best week of 2022, which was good. And this week, the Dow Jones ended at 35,089. It down 21 points and up 1% for the week. The S&P 500 ended at 4,500, up 1.5% for the week. And the NASDAQ, they ended the week at 14,098, and which was up 2.3% for the week. Tech analyst Aaron Tesler from Raymond James puts Amazon as a buy with a new price target of $3,800. Well, David Giroux is the Chief Financial Officer of the $1.6 trillion financial firm T. Rowe Price. Many of you may have mutual funds or retirement accounts at T. Rowe Price. He's also written a new book called Capital Allocation that we'll also be discussing. So let's get to him right now. Hi, Dave. Welcome to Wall Street Wrap-Up.
Wonderful to be here. Thank you for the invitation.
David, for the last year in 2021, stocks have been doing really well. How do you think stocks and equities are going to be doing for this new year?
I think it's a tough backdrop. I mean, you correctly alluded to the idea that 2021 was a stellar year for equities. The S&P 500 was up almost 29% last year, but the backdrop for 2022, 2023, 2024, not nearly as good. We have the Fed raising rates. We have earnings growth will probably slow off of very, very high levels we saw in 2021. We have valuations that are a little bit elevated.
You talked about the Federal Reserve, and it's almost probably a given that, and please correct me if I'm wrong, but I would assume in March when the Federal Reserve meets that they're going to be raising interest rates at that time, and probably 2, 3, maybe even 4 times, a number of times for the rest of this year. Even though we know it, do you think that the market is still going to go haywire and the market will drop when those times do occur?
I think it's a great question, and I think I would agree with you. The Fed is likely to raise rates in March. It's even possible they might do 50 bips in March. The challenge is the Fed is behind the curve a little bit here, a little bit late. They've continued to do quantitative easing into a little bit of an overheating economy, and that's been a mistake. I think the market is fully priced in, 3-4%, 3 to 4 hikes this year. But the question is really, if we think about this time next year, where is inflation? Is inflation at 2.5%? If that's the case, I think the Fed will say we're probably we can slow the rate of increases. Right? Is the economy now operating at below trend levels? As a lot of the stimulus is out of the economy. The challenge really is what happens in the second half of the year. We're still looking at 4 to 5% inflation, right? And the Fed has to be much more aggressive. Now, again, I don't think that's the base case, but if that were to play out, I think that's where you get into trouble.
It's interesting, David, and it's that while we're talking about there will be hiking rates, they're still buying bonds. And now it's not the 120 billion a month like there originally, but it's still, and correct me if I'm wrong, I think, what is it, 115 or 110 billion per month. So even though we're talking about a March probable rate of 25 or, as you say, 50 basis points, they're still buying bonds and pumping that kind of money into the economy. And you were just talking about inflation. What do you think that does?
I'm a big believer that monetary policy does a really good job at inflating financial assets. Most of the inflation we are seeing today in the economy is a function really of fiscal policy and not monetary policy. Essentially what's happened is you took $5.3 trillion, pumped a lot of that into the economy. That got into real people's pockets, not just the wealthy, got into everybody's pockets, and people went out and they spent it. At the same time, people went out and spent that money, we had COVID. And so that's caused, so you have a big increase in demand for goods, especially consumer durables. At the same time, the supply of those durables has been under pressure because of lockdowns in Asia, because of chip issues. And so you have this supply-demand imbalance that is causing all this inflation we're seeing.
I had read where they found that there's about $4 to $5 trillion, just like what you were talking about, of cash reserves, that money in the bank in not just around the globe, we're talking just in the United States, of $4 trillion in cash reserves, checking accounts and such. Well, even if just a portion of that winds its way into equities and stocks, first off, do you think that number is still the same, about $4 trillion? And second, if it is, do you think that will be finding its way into the stock market?
Yeah, again, I think there's a lot of numbers being thrown around there. What I would tell you is when we look at it, it's about $2.5 trillion of what we would call excess deposits. Now, one of the challenges, though, is a large chunk of that is held by, let's say, the second or third highest income brackets. And those people are much more likely to invest those proceeds as opposed to spending those proceeds.
David, in your book, Capital Allocation, it was very interesting the way you wrote, because you said you were very surprised before, when doing research for the book or starting to write it, on just how many companies were not properly using their capital to allocating capital in the right way. Did you find still, when you finished the book, it was still the same way, that you were kind of surprised of the CEOs, and whether they be public companies or private companies?
Well, I think if you look at it at a macro level, over almost every last 10 years, last 20 years, the academic evidence is pretty darn clear that companies deploy capital suboptimally. They buy back stock at the top of the economic market, at the top of the stock market. They tend to do more M&A late in the economic cycle. Companies that are more cyclical tend to increase capital spending at an inopportune time as well. And the result of all that is suboptimal allocation of capital. And the average company is doing it poorly. Mm-hmm. Now, again, in the book, we spent a lot of time talking about the stories of companies that have deployed capital exceedingly well and kind of beaten the odds over the last decade and created a tremendous amount of value for their shareholders. And we also talk about a handful of companies that have kind of struggled from capital allocation. We look at the process errors they made And hopefully people can learn from those errors over time to get better.
2 months ago, a month and a half, 2 months ago, we had Oscar Munoz on, and Oscar was the former CEO and chairman of United Airlines. And I asked him that exact question because, as you know, all the airlines went to the government because they needed capital to keep their employees, employed while all airlines were shut down. And I asked him about the capital intensity, the intensiveness of an airline, and whether or not can you keep that kind of capital on the sidelines. And that's what we were talking about. One of the things you were talking about, things not to do. Okay, a business. I'm talking about businesses, what not to do in a downturn. And one of them is like cut the dividend, because I guess that would cause a panic, a fear for people who have lived on dividends for those companies. And my first thought, I'm thinking of, you've got companies, let's say Apple. Now, Apple has not only not ever cut their dividends, but they've always raised it every year. But then you've got some companies, such as IBM, that need to borrow. I think they borrowed money to keep their dividend going. And also, if I'm not mistaken, I think also ExxonMobil. Do you think that when companies are going into a downturn, as we may be seeing in 2022, do you think it's wise for a business to borrow money to be paying their dividends?
Absolutely not. Yeah, that's a great point, a great question. What I would tell you is dividends should be set at a level that is sustainable in good times and bad times, right? For a company like a IBM, like an Exxon, that are either cyclical in the case of Exxon, or that have secular challenges like IBM, their businesses over time kind of decaying, if you will. These are companies that should probably do more special dividends. They shouldn't be buying back stock. They shouldn't have a dividend. Every year, they should, at the end of the year, however much excess capital is left over, they should return that capital to shareholders, as opposed to creating a dividend that you're constantly having to cut and increase and cut depending on where you are in the economic cycle. And those companies also should not be buying back stock. Exxon bought back a lot of stock over the years. Those at much higher valuations, much higher stock levels. A lot of the cyclical companies buying back stock is usually a recipe for value destruction.
David, at one time, you liked GE, and I remember you also liked Amazon. And I'm not sure exactly how far back that goes. Are those two companies that you still like, GE and Amazon?
We do. I mean, I think the story on both of those companies is quite compelling. We have GE, who's going to split into three pieces in the next 2 years. Mm-hmm. Their earnings in their best business are kind of cyclically depressed because of COVID, if you will. And if we believe we are that COVID will become more endemic going forward, and that should allow kind of travel, and especially airline travel, to get back to normal as we think about 23 and 24. And that's going to generate a tremendous amount of incremental free cash flow for that really attractive aerospace business. In addition, the healthcare business is a great business. And I even think that the power renewables business is underrated. We think some of the parts 2 years out for GE could be as high as 160, even using relatively conservative assumptions. Wow. On Amazon, again, the stock's basically $100 today. And if you think about Amazon, if you look at the valuation of it relative to like Walmart, if you take out the value of AWS, which is their fast-growing cloud computing franchise, you can make a really strong argument that you're not paying very much at all for that core retail business that will probably do $800 billion of gross merchandise value in kind of 2023. I mean, it's actually trading at a discount to Walmart on some metrics if you X out AWS. But AWS is a great business, and even the retail business is a very good business. We actually think Amazon has potential from these levels to probably double in value over the next 4 years. And again, it's been relative to the other FANG stocks. Mm-hmm. It's been a laggard here, even though the fundamentals we expect to get better on the retail business in the second half of 2022, as well as the core AWS business we expect to continue to do extraordinarily well.
Do you think, David, when when it comes to Amazon, do you think that their retail business will be more of a grower than their AWS, their cloud services, or do you think that they will both be be growing at like as such as an equal pace?
Well, actually, the AWS business is structurally growing at a faster pace right now. It's a smaller business, so it's easier to grow. They're earlier in their TAM penetration. You think about cloud computing, we're only probably about 10 to 15% of the market penetration there. Whereas, I mean, on e-commerce, we're making good progress there today. So, that's a little bit further in the penetration curve. But we still think in the second half of this year, Amazon, its core retail business gets back to kind of mid-teens growth, but we think the AWS business is more like a 20 to 25% grower over this time period.
We're talking with David Giroux. We're very happy to have him from T. Rowe Price. He is the Chief Investment Officer for T. Rowe Price. We'll be right back after these messages. We're talking with David Giroux, and David is the Chief Investment Officer for T. Rowe Price. We're happy to have him. We're talking about stocks, and we're talking about a number of things that go heading into the 2022 year. David, when we left, we were just talking about GE, and we were talking about Amazon, but one of the things you have a knack for is I've been doing a lot of reading about you, and you have a knack of knowing when to pull the trigger, not just of when to buy a stock, but when to sell a stock. Well, what do you look for? What are your metrics that you use to going, we're out or we went in?
Usually, when we are looking, if you look at the vast majority of times we enter a new stock, it's usually because there's some kind of controversy, some uncertainty, not usually a long-term uncertainty, but more of a short-term uncertainty that's impacting the stock. And we think there's no easier way to make money in the market than to buy a great company that's going through some short-term issues that if we have a long enough time horizon, we believe those short-term concerns will go away. And so, you mentioned, we talked about GE, we talked about Amazon. These are great companies that are going through some tough, some near-term challenges. Like GE has issue with COVID, and Amazon has tough comparisons with their retail business because of the pandemic, right? Both are going through some short-term issues, but you look at 2 to 3 years, the outlook is very, very positive. So we want to buy ahead of fundamentals turning when valuation and sentiment is not on our when valuation is attractive and sentiment is not positive. Stocks where where we decide to sell, right? Sometimes in the fall of 2020, banks were really, really cheap. No one was talking about inflation. No one was talking about the Fed raising rates. And we had a view, so we put billions upon billions of dollars to work in banks. Well, fast forward 15, 16 months, a lot of these banks have doubled. The market has, the valuation of banks have risen. People are flocking to banks because of, potential for rising rates. And they want to play banks because they benefit from rising rates. But the stock's already doubled. That's when we want to reduce our exposure, right? We are consistently going against the grain.
You even have it in your book about, with capital allocation, about the black swan moments. You were just talking just now about events that occur that are temporary. Now, when you're in it, it may not feel temporary. But first off, for our audience, would you tell us what is a black swan?
Black swan is best characterized as a very low probability event that it's very hard to plan for. Like when we talk about we think about COVID, right? We really haven't had a pandemic in this country or globally that essentially shut down the economy and drove the economy into a multi-quarter recession. That is a rare event, right? That is a black swan event. Let's call it a 1 in 100 year event, right? I'm not, if Putin invaded Ukraine, I'm not sure we would have a similar event, but there would be certain companies that would benefit rather dramatically if that were to occur. Potentially, companies that have defense exposure could benefit from that if that were to play out. But I think a black swan is a very rare event, very low probability, hard to predict.
Now, for those are the type of events that you're talking about that I know you at T. Rowe Price like to buy because it's a temporary event that you're going for long term. When your fund managers, I mean, are you looking at holding stocks for X amount of years? I mean, are you buying such as the Warren Buffett way of having only amount of punch cards around a punch card, so you're very judicious as to what you buy, or you may hold a stock for maybe a month or 2 months, maybe less or maybe more? What type of guidelines do you have?
We let the opportunity speak to us, if you will. So there's not a lot of situations where we buy a stock 1 month and it's gone the next month. That's not what we do. But think about, I was talking about some of the banks we were buying in kind of, let's say, August, September of 2020. We had a 5-year view. We thought these were stocks that could probably appreciate in value at a 15 to 20% kind of clip over the next 5 years. Now, what happened was, as fundamentals got much better than we thought, as people got excited about rates, these stocks doubled, right? So we got 5 years of returns in basically 15 months, right?
Mm-hmm.
So it wasn't like we said, oh, we have to own this for 5 years. We already got 5 years of returns in 15 months, right? So, and the result of that is we now some other names where maybe take longer, right?
Uh-huh.
GE, because of COVID, it's taken longer to get to a level where we would want to think about reducing the exposure to GE someday. We're not even close to that level today. We usually are buying things that are under pressure, selling things that are in favor, that have done well, where valuation is stretched. That's kind of the arbitrage we tend to exploit in the marketplace.
Are you going to be launching a new division later on in the year that you're going to be using different strategies? Can you kind of tell me what it won't be just between you and I promise you, but what the strategies are that you're going to be launching?
Sure. T. Rowe is staying one company, but we will have 2 separate legal entities in the future. So I am going with the new entity, which is called T. Rowe Price Investment Management. I'll be the CIO of the new entity. That new entity will have 5 of our funds, of which capital appreciation will be 1. So we'll have, and essentially what this will really do is allow us to have more flexibility on growth going forward. Make it easier for us to get, in their certain circumstances with maybe a small cap or a mid cap idea where, we have capacity limitations. And in many respects, separating, legacy TRPA from TRPM will help alleviate some of these capacity challenges, allowing us to own more of the companies we want to own in, larger quantities than we have in the past. So we're very excited about this entity.
I've got time for one more question this time, but I hope you come back. All right. What's the best investment advice were you ever given?
The best investment advice, that's a really good question. I think the best investment advice I've ever been given, and it's not easy to do, is ignore the market. You shouldn't listen to what all the experts are saying right now. There's a tremendous amount of recency bias in markets. And again, like I said, no one was talking about inflation 15 months ago. Now everybody's talking about inflation. If you are consistently investing what the market tells you that you should be doing, you're going to destroy a lot of value for your shareholders long term. Be willing to think outside the box, be willing to have a longer time horizon, and be willing to go against the grain. That is how you create value for shareholders on a longer term basis.
David, what a great way to end this segment, but I hope it's not the last one. I hope you come back. I thoroughly enjoyed your time.
Oh, good. Thank you for the invitation. I enjoyed the conversation.
Thanks so much, Dave. That's David Giroux from T. Rowe Price. Well, if you've got a question about finance or a comment about the show, we want to hear from you. Make it pithy, make it concise, and write us at Andre@wallstreetwrapup.info. And now for a look ahead for next week. But first, what business was launched on this day, February 4th in 2004, by a Harvard sophomore in his dorm room? We'll have the answer in just a minute. Well, what business was launched on this day, February 4th in 2004, by a Harvard sophomore in his dorm room? Facebook. Mark Zuckerberg, the CEO, originally used it to rate girls at Harvard. He called it the Facebook. In fact, by the way, the original name prior to Facebook, he called it Face Mash. I'm really glad he changed the name. And speaking of Meta, or Facebook, as it was called, as it was originally called, this week Facebook released their last fourth quarter earnings, and analysts didn't like what they heard, slashing 40% from their 52-week highs. With the drop this week with Meta, also known as Facebook, it was the largest single drop in value of a publicly traded company in U.S. stock market history. Facebook dropped $250 billion this week in market value. And Mark Zuckerberg, the CEO, well, he lost $30 billion of his stock. But as former Senator Everett Dirksen used to say, a billion here and a billion there, and pretty soon we're talking some real money. Mark Zuckerberg. So, in 2 weeks, now we're going to be talking with investigative business reporter Charlie Gasparino. Now, Charlie's the business reporter for Fox Business and Fox News. Now, prior to that, he was also doing the same as investigative reporter at CNBC. He's broken many business stories, and with the jury finding Elizabeth Holmes guilty of fraud as CEO of Theranos to insider trading on Capitol Hill, Charlie has reported on it all. He's also a columnist for the New York Post, and he'll be with us in a couple of weeks. From Fox Business, Charlie Gasparino. And next week on Wall Street Wrap-Up, I'm sure you've been hearing of the Russian buildup of troops along the Ukrainian border. Will Vladimir Putin invade? Well, next week, we're going to have a unique perspective from someone who's been on the battlefields to commanding large forces. My guest next week will be Major General James Livingston. Now, as a young man, he joined the Marines as a second lieutenant. And while fighting in Vietnam for bravery and valor, he was awarded this country's highest award, the Medal of Honor. He rose from second lieutenant in the Marines to major general. Will the Russia pull the trigger and invade Ukraine? What did pull out of Afghanistan tell players like Vladimir Putin or Xi Jinping of China, or Iran for that matter? Well, next week, my special guest, Major General James Livingston, right here on Wall Street Wrap-Up. And as a reminder, we repeat the show on Sunday mornings, but remember, the best way is to set your DVR so you'll never miss an episode. Well, and that's our show for this Friday, February the 4th, 2022. I hope you've enjoyed it. My thanks so much to David Giroux from T. Rowe Price for joining us this evening. But as always, we appreciate you for allowing us into your homes tonight. Remember, you can always follow us on all the social media, on Facebook, or Meta, as it's now called, YouTube and Twitter, and WYES.org. So enjoy your weekend ahead. Have a great, productive week as well. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.